It's a decision so life-changing it takes your breath away. And while the emotional and physical comfort might be top of mind, let's not forget the financial support a marriage can give you. Marriage is the most important financial decision you will make, which is why it's so important to focus on your combined financial plan.
Managing and planning your finances together might seem like a small task, but if you spend some time on it, you could make some larger tasks a lot easier, like buying a home, a car, or planning for your children. But before we get you started on your financial plan, here are two very important things that you need to do first. First things first, you need to open two joint accounts. One expense account for all your expenses, and the second, an investment and savings account that will help you both supervise and handle your savings better. The second most important thing that you should do, and most couples tend to ignore this one, is change the nominees from your parents to your spouse on all the assets that you have, like your bank accounts, your mutual funds, and your insurance policy. Once you've done this, you can start to plan your finances together.
Now, another thing you have to do before you get started, ladies, is decide if you're going to change your name. And in case you are, then get through the legalities of that first. Change your name on your bank accounts, your insurance policies, and all of your investments, so there's no confusion in the future. And once you've done that, you can get started on this financial plan that we've set up. Remember, it's really simple. It's only 5 new steps that you need to go through as a new couple. Start with talking about it. Have a conversation charting out your spending habits. Which of you is going to pay the bills and which of you is going to save?
You know, the first thing that a newlywed couple must do is sit down, and the two people should talk about what their attitudes towards money are, what their values towards money are, and what they plan to do as far as their financial decisions are concerned in their collective lives. They're no longer thinking individually.
Then you come down to translating that into actionable activities, which involves creating asset pools, doing risk management, and planning a savings rate. Because for a young couple, it's often the backward calculation of savings rate from their requirements.
Then you get down to business and chalk out your financial plan. Step 1. Insurance. You need to make sure your spouse is secure if something were to happen to you. So both of you should buy term insurance to cover at least 10 times your annual income.
Now that you're married, your financial goals will change, and the financial protection that you need is very different. Now you have to cover the risk of dying too young and leaving a dependent, or leaving somebody who's left to pick up the pieces after you. So a term life insurance is very critical.
The first claim on your savings is that of risk-proofing your financial life, which essentially means life cover needs to be taken in sufficient amount for both husband and wife. After that is general insurance, which involves medical insurance.
Here's a tip. Some health insurance policies cover pregnancy-related expenses. Make sure the policy you choose includes that cover. Chances are you're going to need it. Step 2. Do an audit. Make a list of the loans both parties have brought to the table and the EMI obligations that come with them. Then start by paying off the expensive debt first.
Credit card is the most expensive loan. Pay off that earlier. Personal loan is the second most expensive. Then comes auto, and mortgage is the cheapest.
Typically, couples should be thinking of taking on debt only for items that are increasing in value, such as a home. You would expect your home to appreciate in value over, say, 4 or 5 years or 10 years. Whereas if you take on a loan to buy a cell phone, chances are a cell phone that I buy today on loan is not going to be worth much 2 years from now, because it'll suffer from obsolescence.
As a tip, education loans and housing loans will give you tax benefits, so don't pre-close those loans in a hurry. Your next step is to list out your short-term responsibilities. Decide when you want to start a family and what kind of financial support you want to offer either set of parents.
Similarly, they need to think about how they're going to take care of their own family, whether that's the following generation, such as their children, or it's the previous generation, such as respective set of parents. Is the husband going to be supporting his parents, and is the wife going to be supporting only her parents?
Everything needs to be discussed, and some kind of an operating rules made up. Again, not very romantic, better ways to spend newly married life. But if you put in those signposts, those guideposts, it will lead to a very happy married life.
Once you know what your targets are, work backwards and figure out the savings you will need to set aside every month to meet those targets. Here's a tip. If your target is 5 years away, then investing your savings in a large cap, equity diversified mutual fund will help you be better prepared against inflation. Your next step, plan out your biggest financial goal, your home. You need to decide when you want to buy a home and for how much.
Real estate prices would on a normal basis keep increasing faster than your savings. So you have to put in your investments into asset classes which will give you a return, which keeps your money savings in line with your financial goal.
Here's a formula you could work with. Use the current going rate of a home you might want to buy. Work in a 50% annual growth rate into that price. Now you need to start saving at least 20% of the value of that home, so you have enough to make a down payment when you're ready to buy your house.
If you plan to buy a house of 50 lakh, which means you have to accumulate 10 lakhs. And so keep investing in equity funds by way of SIP, choose 1 or 2 good funds and keep investing. As you get closer to 8 lakh rupees, as you are able to accumulate 8 lakh, then you start, think of steadily moving a good part of your money into fixed income, as you will be able to insulate yourself from the market risk, and you'll be very close to approaching your goal.
As a couple, you're allowed to take a combined home loan. You will be entitled to a higher home loan value and a better interest rate.
Your creditworthiness goes up because you're married, you're considered more stable. With due apologies to all the single people out there, but in credit terms, people say that they want to settle down, they will use this home to stay, and your first home and home used as primary residence, that gets you a better credit score immediately. Second, your incomes get combined, so your loan servicing is higher, so you will get a higher amount of loan. Third, you might even get a better interest rate.
That brings us to step 5, tax planning. One of the biggest advantages of being married is a combined tax plan. You can use both your salaries to maximize your tax deduction, especially for a home loan.
Make full use, because both of you can get tax deduction, both on the principal as well as on the interest. Interest up to 150,000 rupees per annum in both your tax returns, and principal up to 100,000 under ATC along with other ATC benefits. So make full use and make sure you're taking the home loan in a joint name.
Each taxpayer is entitled to a 15,000 rupee deduction under section 80D for healthcare related expenses. And if both the husband and the wife are working, that's close to a 30,000 rupee deduction that they can get. So maybe the husband can take a health insurance floater policy for the husband and the wife can buy something towards the parents. That way they can maximize the deduction that they're getting.
And a tip, wedding gifts are tax-free. So your wedding is a good time to take jewelry, property or cash onto your books. And finally, a recap. Buy insurance, audit your debts and EMIs, start saving for your long-term and short-term goals, and make the most of your tax deductions. And remember, if you plan your finances today, the honeymoon might never end. So remember, get started today, especially if you plan to buy a home in the next few years. 98% of the couples who get married want to do so. So anything you set aside and save today will help you buy a bigger home with a smaller loan in the future. So good luck and congratulations.